Hello, everyone, and thank you for joining us for another episode of the Financial Commute. I'm your host, Chris Galeski, joined by CEO of Morton Wealth, Jeff Sarti. Jeff, thanks for joining us.
Great to be here, Chris.
You know, there's a lot to talk about, especially this year with kind of what's going on in the market. We got elections, we got inflation, we've got crypto and gold going all over the place.
Yeah.
But, you know, today we're talking a little bit more detail about the role of stocks in a portfolio.
Mm-hmm. Sure.
And some about valuations as well. And just the role of investing.
Mm-hmm.
Funny enough, I was over the weekend, my wife and I were going to Costco, and we decided to go to a sandwich place before Costco because the girls were hungry.
Mm-hmm.
So I'm sitting in this sandwich place with my wife, my 4-year-old, my 18-month-old, and sitting next to this table of this young couple that was in their early to mid-20s. Mm-hmm. And I couldn't help but overhear them talking about investing. Yeah. So my ear kind of perked up. And I heard the gentleman say to his girlfriend, he said, yeah, and just imagine if you put that amount every year into your Roth IRA and got these returns in just a simple index fund, here's what your account would be worth now. And he showed her his phone.
Okay.
And she was just like, wow, that's a lot of money. I wish I would have known that. And part of me was just elated that there was two young couples, two young people
investments. That's
talking
great.
about investing.
Yeah.
But you know, for him to set the expectation that, yes, you know, a simple index fund has done 10 to 12% a year the last 10, 12 years, and that's going to happen the next 10 years. I mean, he's potentially setting her up for, you know, some frustration if valuations come down a little bit.
Yeah, no, great point. Yeah, we all think it's our God-given right to generate, call it 10% a year in stock returns, because that's what most of the past has shown us. But as you mentioned, it could be a little bit of a choppier ride from one decade to the next, without a doubt.
Right. I mean, even if you just started investing in a given year,
Sure.
just a normal fluctuation in a given year's, you know, 10 to 15% in value. Yeah. So, you know, I know most years the stock market is up, but if I invested, you know, $100 and it went down to 85, that's a lot different than what, you know, her friend was potentially telling her.
Yeah, and we've been so spoiled. Outside of 2022, each year in the last, call it 12 to 15 years, has mainly been up. So they've been really spoiled by those upward moving returns.
Yeah, but if you look back, so I agree with you, but if you look back to those years that stocks did really, really well in the last 15, they were forced to. Interest rates were held at zero. Yeah. People that were investors or savers, they had nowhere else to go and invest because the majority of our industry just invests in stocks and bonds. Yeah. We're far different. We have access to real estate and gold and other types of private lending. And so when interest rates are at zero, it's going to force investors to kind of take on more risk and invest in more and more stocks. Yep. And so where I get frustrated with our industry is they say, oh, this is the only way you should do it.
Right.
And that's not accurate. There's a lot of different ways to help protect, grow, and generate income for people. But what's the purpose of investing in general? Like if you think about why people should be investing.
I mean, just generally, you have to take on some risk, right? Mainly to beat inflation. Inflation is the key driver of why you really have to put your dollars to work. Because if you just put your money under a mattress, right, that $100, you wake up in 5 years, it's still $100. But the price of the goods and services went up, you know, by X% a year over that 5 years, and now all of a sudden you're underwater. And inflation now is top of mind. For the last, call it 15 years, we've really been in an environment where inflation has been fairly low. So that mindset hasn't really been a huge issue because it was really easy to beat a 2% inflation rate. But now that inflation's higher and a little bit stickier, I mean, it's even more crucial that you have to take risks with your assets and invest in a variety of asset classes with the goal of outpacing inflation or the cost of living over time. I mean, at its core, that's what you're trying to do.
Yeah, I mean, inflation just erodes your purchasing power over time. And really what it does is, yes, it's causing you to buy less goods and services, but it's stealing your time. Yeah. Because now, as a saver or an investor, I have to take more time or more energy to be able to save that same amount needed to purchase that home or that car or those groceries. And so, you know, people, if you value your time, people should be investing and trying to grow so that way inflation doesn't hurt them over the long run. Yeah. Let's talk a little bit more about kind of the role that stocks play in the portfolio.
Stocks, one, from a long-term point of view, and we're going to talk about valuations and our thoughts about stock returns going forward. But from a big picture point of view, stocks are a wonderful way to have exposure to global growth. When you think about beyond just real estate and the private lending and other investments we do, one wonderful way to get exposure to all industries around the globe, from financials to technology to consumer goods, you name it, it's really through stocks. And it's a way, again, not just to get sector exposure, but geographical exposure too across various international countries. So it's a wonderful way to get exposure to growth assets.
I mean, most of these companies are companies that we're spending our money, at, day in and day out, whether, not to promote any names, not giving financial advice here to go buy any names, but you think of like the Costco's, the Targets, the Procter and Gamble's, the Apples of the world. I mean, the world is spending money at these places. And so it's nice to have exposure to those companies to help offset that growth. The industry in the talking head say stocks do this every single year. And, historically it's around 10% a year. And so now all of a sudden people have that expectation of, hey, stocks should be up 10. And we even see it from time to time when we have a year where stocks are flat. Some clients are like, hey, what's going on here? So the industry likes to promote this as fact when in reality, if you look back, it is not.
That's a great point. So yes, from a long-term point of view, if we're talking.
But what's long-term?
It's a great question. So if you go back, let's say for the last 100 years, yes, stocks have averaged, let's say, roughly around 10%, a real nice risk-adjusted return. But I think if you ask that question, what is long-term? I think the most common answer we get is call it 10-ish years. And actually, and I would agree, that is a long time, right? But if you look over rolling 10-year periods, there are plenty of times over the last 100 years where stocks really underperformed. And we're even call it flattish, performed, flat, definitely underperformed inflation over those 10-year periods. So I think when you're investing in stocks, you really even have to have a 15 to even 20-year mindset.
Yeah, you're kind of alluding to, like the lost decade of, call it the late 90s, early 2000s. Yeah. There was a number of other cycles. And so why do we have these periods where we've got tremendous growth in stocks, but then also stocks going sideways, both domestic, international?
At its core, the most powerful predictor of future long-term returns, it's valuations. Valuations as a starting point.
So the price that you buy something at.
Yeah, simple valuation, let's say a price to earnings ratio, that's a classic metric that most look at. So if a company produces $1 of earnings, if you pay $10 for that stock, that would be a 10 price to earnings ratio. If you pay $20 for that same stock, that would be a 20 price to earnings ratio. And what history shows, we all look at recessions and other economic indicators. The most important predictor of future returns is just simply valuations. If your starting point are cheap valuations, and we'll go over some historical examples, but let's say 1982 is an example. Stocks were very cheap. The next 2 decades, stocks did very well. It was mainly because stocks were just cheap as a starting point. You mentioned the lost decade of the late 2000s. 1999, we hit peak valuations. We all know the dot-com bubble. So what happened the decade thereafter? Very poor returns as valuations came back to earth.
Yeah, and that's just a couple examples in the U.S. You can even go to the Nikkei and other other markets around the world, and there's definitely been periods of these lost decades. Yeah. So some other examples, so we've got like 1929, 1966, and 1999, where there was long stretches of time where the market was basically flat, and that has to do with valuation.
Can we go over a couple of those examples? Because I just looked at this data, and it was even alarming to me to some degree, the extent by which stocks underperformed by quite a long period of time. So we all know the 1929 stock bubble where valuations reached pretty high extremes. The stock market did not come back to even until 1943. So basically almost 15 years just to break even. Obviously, then you're losing out to inflation over that time frame as well. You mentioned 1966, again, reached a high level of valuations in the mid to late 60s. Stocks didn't break even there. I think it was basically 1974 or 1975, so about an 8 or 9 year period. But the actual story is worse than that because remember, that was a very high inflationary time. So to match inflation, it took to 1982. So if you look from 1966 to 1982, inflation averaged 6% over that 16-year period. That's what stocks average. So it took 16 years to break even with inflation.
Wow.
And then the last one, which we quickly mentioned, was 1999. So the lost decade of the 2000s. It basically was 10-ish years where stocks were flat after the 1999 bubble.
It's so fascinating. I mean, most clients say, hey, I don't want to lose money because I don't think that I have the time to make up for it. And so that's why preservation of capital is so important. We also need to generate income. But when you talk about valuations, let's go with the price to earnings ratio.
Yeah, sure.
What's the price to earnings ratio right now?
Based on various metrics, whether you're looking at previous 12 months earnings or forward earnings, that number could differ a little bit. But call it we're in the mid-20 range. So sort of in the 23 to 25 price to earnings ratio. And for context for the audience, that is expensive. I mean, that's not mildly expensive. It really is borderline very expensive. The only real time that exceeded that from a valuation point of view was the late 90s bubble. We talk about other extremes, 1929, 1966. Those were more in the high teens PE ratios, and we've exceeded those in the current environment.
I don't remember. I know that 15 years ago when I started this industry, I was at Morgan Stanley, and I feel like some other advisors were talking about, PE ratios tend to be around like the 12 to 15 range.
Sure.
Call it that. So let's just pick a number. Let's say 14.
Yeah.
The 1929, when it took, 14 years for the market to come back to even, the PE ratio was 18 at 1929, and it came all the way down to 8.
Came down to 8.
So that's a difference between like, hey, I want to be a seller at 18 and a buyer at 8.
Yep.
Similar story in 1966 where the PE ratio was around 18, and it came down to 7.
Yeah, early 80s when no one wanted to touch stocks, right? The PE ratio was in the 7 to 8 range.
Right.
Incredibly attractive at that time.
Mortgage rates were, 11, 12?
Even higher than that, yeah.
And then in the dot-com bubble, the PE ratio you mentioned peaked at, call it low 30s, 33.
And then it dropped down to call it the low teens, in the decade, in the 2009, 2010 timeframe, a decade later, yeah.
I'm glad that you mentioned how important valuations are. It's just like anything, whether it's stocks or real estate or art. The price at which you're going to get in the future and the growth or the performance greatly is determined by the amount that you originally paid for it. And there's times where, there's a lot of money flooding to one asset or another. We're not calling for a crash, but just trying to educate the audience on the importance of valuations and why we're cautious with regards to stocks in the current environment.
Yeah, to your point, listen, again, as the audience knows, we have no crystal ball, nor are we attempting to try to time the market. That being said, history matters. And as we mentioned in the beginning of this discussion, nothing matters more to future returns than starting valuations. So with that lens of history, our best guess is that stock returns might be more disappointing for the decade to come as compared to the decade that has just happened. So again, we of course own stocks for a variety of reasons. That being said, this is one of the main reasons why we're so passionate about being in other asset classes where we think we can generate stock-like returns, call it that high single-digit, low double-digit return without taking on these risks, namely valuation risks that we've been speaking about.
Yeah, I feel like the old guy in the room wanting to talk about how good bonds are or the private lending or the loans are today. But really, because interest rates have come up from zero, there are some very attractive returns that we are finding, whether it's in the fixed income, private credit space.
Yeah.
And so we are able to generate sort of longer term stock-like returns from that without taking nearly as much risk or volatility.
Yep.
Jeff, thank you so much for joining us, and we'll see how this plays out. But please pay attention. Valuations matter. I'm excited about some of the things that we're seeing in the market and the growth, but just be cautious.
Thanks, Chris.